And what happens when you default? If you're not ready to refinance at the end of that, and the private lender's not willing to renew the debt, you can be in a little bit of hot water.
Award-winning mortgage broker, director and principal mortgage broker of the Lending Lab.
I have the pleasure today of having Nick Clunes, the director of the Lending Lab, with us today. Nick, welcome to the WTF Podcast.
Thanks, Bill. It's great to be here.
Yeah. Well, Nick, do you mind telling the audience a little bit about yourself and I guess most importantly, how did you become the principal mortgage broker at the Lending Lab?
Yeah, no worries. I'll give you a little bit of background. So essentially, I've been in the lending game for about 6 years now. I started off as a business banker, actually. So I worked for a second-tier bank, customer-owned, and we used to do trust lending and a bit of construction and some of the bigger, more complex stuff. And stepping away from that, I then went to Aussie Home Loans as a broker for a little while and did really well there. I wrote 100 mil in the first 12 months, which is great. And yeah, very quickly outgrew that. And one of the people at Aussie was Fabian Tribe. He was one of the regional managers at the time. And yeah, essentially we both exited Aussie. He exited first, I come slightly after, and set up the Lending Lab with the goal of educating more Australians about property and having more of a digital presence and digital journey. I think some of the biggest factors. Yeah,
excellent. So when did you start, working as a business banker?
That was 2018, I believe. Very start of 2018.
Okay.
Yes.
Yeah, great. And so obviously you've been in the game for quite some time.
Yes.
And especially I think since COVID, the property landscape's changed a lot.
Massively.
Yeah. So what have you seen being the biggest, changes in terms of, I suppose, the property landscape and also the lending landscape over the last, half dozen years?
Yeah, 100%. Well, I think the main thing is the serviceability and the interest rates, as everyone knows. That's what everyone bangs on about. But probably the biggest change is the servicing. So I think we've seen lenders tighten up their books as we kind of come through COVID. And we certainly have now, especially with some policies that have come out, it's certainly opened up a lot more. Okay. So lenders are now more flexible on LVRs. They're not under as strict as what they used to be through that COVID period. And the lending criteria has certainly softened, which is great. And I think that's reflected in the market as well with the boom that we're now experiencing and whatnot with the commercial property. It's certainly due to that cash being available, people being able to access the money easier. A lot of the red tape in commercial is now starting to disappear as well, which is good because pre-COVID, it was relatively easy, and there were some things that were quite simple. Coming into COVID, I know us as a bank, we tightened up really. It was very interesting how much we kind of closed the purse strings and didn't lend money. So coming out of COVID now and having flexible policies and being able to lend money is fantastic.
Yeah, so I want to touch on that as well because obviously most of our viewers here, they're commercial property buyers, investors, and it's always, for me anyway, it's always been a challenge for me to understand how banks decide when to tighten up the purse and when not to. So what are some of the key drivers or economic reasons for them to either open up or close?
Yeah, so I think there's a couple of reasons that banks would do that. One of the main one is their existing book. So they have a look at their book of lending, what LVRs they have approximately based on their bank valuations, as well as their arrears percentage and where they sit in the market. And based on that, if banks feel like they're overweighted in commercial, they may start to pull out of the commercial market. You see it very commonly with some of the cash flow lenders in the business space. They enter and exit the market quite rapidly when they've got funding, when they don't.
Can you just explain what cash flow lender is?
Yes. So when you have a trading business, for example, that needs some funds just for their daily operations in the commercial space, essentially cash flow lenders are small non-bank private lenders who have outside funding lines generally, and they provide the short-term 24 to maybe 36-month loans to those businesses. So it's more for the tenants of the commercial property. It's probably the main people who would access that. But those facilities are starting to see a bit of a pickup now, but they enter and exit the market rather rapidly. Banks enter and exit a lot slower in terms of their lending. They, tighten. Generally, it takes a little bit for them to tighten, a little bit for them to soften. The main way they tighten up is they increase the servicing hurdles. It's generally a big one. So a good example is a major out there that most of us probably know, that when it comes to retail property, it's almost double in terms of the servicing hurdle.
Right.
So the rental income you need to service that loan, or the income in general, is quite a bit higher than if you go to some of the other majors who are more happy with the retail premises and will lend more money on that. So that's one of the main ways they adjust it, but it's normally related to back book. It's probably the major thing. I know when I worked for the bank, we had a certain percentage and a certain budget that we could have our total exposure in commercial. And if we were getting close to that, we would have to pull back and, maybe increase the servicing hurdles, maybe be a little bit more picky around the asset selection, decrease LVRs potentially as well. But then again, when we've got a bit of space in the budget, we might take on a larger development or something that's a little bit more risky. So I think it's very much based around the bank's risk appetite. As well as where their risk lies at that point in time.
So outside the 4 major banks,
yes,
how many lenders are there that a commercial property investor can potentially tap into?
Yeah, there's lots. There's probably 10 main ones.
Okay.
The number of lenders are endless because you have your majors, your second tiers, your non-banks, and then your private funders. And there's plenty of private money, some of it nicer than others, which is good.
Yeah.
In terms of non-bank lenders, there's a few more that are starting to play in the space a bit more heavily than what they used to. And we're seeing some faces that we saw and investors may be familiar with in the residential side where they have to go non-bank to squeeze out that extra property. We're now starting to see them in the commercial side as well, which is good. But I would say there's probably 10 that we use regularly. So they consist of the major banks, a couple of the smaller banks like Bank of Queensland and a few others. And then you have your non-bank lenders such as your Latrobes, your Pepper Moneys and those. But there's probably 10 that you would access regularly unless you need the private money.
Yep.
And then there's a whole bunch more, but that's a different playing field.
Yeah. So what's the advantage and disadvantage going major and second tier lenders and private lending?
For sure. So major lenders, the biggest advantage is the rate. Normally they might put you through a stricter process when it comes to borrowing the money. There might be a little bit more red tape, but in return you have a much lower rate. And generally it doesn't mean your transaction's any more risky or less risky than the next person's. However, what it does mean is the way that it was presented to the bank, they've given it a certain risk rating, applied their margin, and generally it's cheaper. The second tier banks, depending on where they're in the commercial market at the moment, their rate may be slightly higher. Their policies are generally a little bit tighter as well, but there are a couple of outliers in the commercial property space, in that second tier bit, where there's really strict document requirements, but the rate might be slightly cheaper than the majors. There's a lot of red tape to navigate, but you might be able to access a cheaper rate. Then when we come to the non-banks, they're happy to lend money. A lot. It's at higher rates, potentially risk fees, but they will, their doors are open. With the non-bank lenders, it's important to remember though, normally their doors are open for quality properties. However, the income might be a little bit different. So generally what they're looking for, they're not looking for an asset that's a little bit questionable. It's a solid asset, and the issue is maybe credit score related, or maybe it's income related, existing debts. That's where the non-bank lenders love to lend. So they're really happy as long as you've got a good security. Private lenders don't care about income. It's purely based on the asset. So if you have a commercial property deal, something's happened, it's going wrong, but we're already unconditional. For example, you get a private lender to step in, give you $2 million at a 50% LVR or whatever it is. It's going to be expensive funding, probably around the 10% mark, but it gets the deal done. You don't lose your deposit, and then we can look at moving to a major later. But private funders, there's a lot of them. They all have different regulations, and if you jump online, New South Wales case law, and read a little bit about some of the private deals that didn't go too well, you'll learn very quickly what to avoid in that private lending space. And
can we talk about that a little bit?
Yeah, for sure.
Because the reason I ask is, most of our clients, as you know, they're private investors, and a lot of them are business owners, so they have a separate balance sheet and income, for the businesses and for the personal investments. And quite often, as you know, banks, they take into consideration that income and not that income, and this income not that income.
Exactly right.
Yeah, and a lot of times they end up relying on private lenders as a backup option.
Yes.
To do the deal. But I think a lot of them go in with a sense of urgency and desperation.
Yeah.
So they don't often read the fine print. So what are some of the things that they should avoid and look out for?
Yeah, for sure. So it's really important you review the term sheet. So when you go to a private lender, generally they'll supply you with a bit of a term sheet. So it'll give you an idea of what we're looking at in terms of how long you can have the facility, how the interest is calculated and charged, what fees are associated with it, and what happens when you default. Because normally private funds for 12 months is the general, 6 to 12 months the general term, and they'll add the interest on top so you don't have a cash outgoing. If you're not ready to refinance at the end of that, and the private lender's not willing to renew the debt, you can be in a little bit of hot water. You might be forced to sell the property. And that's not a major issue, but I think if you're going with a private lender, you really want to understand what the terms are. If you get to the end of that term and you can't refinance, what can we look at? Can we refinance back with a private lender, or are we going to exit that position? But I think as well, one of the major ones that I think comes up often with the private debt, it's the power of attorney. So there's been some before that have come unstuck where the private lenders actually had the customer for borrowing the money, had to sign a power of attorney document. And essentially there was one particular case that I remember reading where they had signed that, they had defaulted on the debt, and the lender took it upon themselves to refinance all of the other mortgages with all the major banks, pull them in, charge them interest, and then sell off all the properties to pay off the debt. It was a very messy deal. You can certainly read about it online, but I think, if you review the terms, and I think it's very important, some of them don't require you get legal advice, but it's very important if it does, get good legal advice from somebody who reviews the contracts regularly. I think it's very important because they can be hooks in those contracts. Especially if something goes wrong. If you go there for 6 months and you refinance, you probably won't have any issues. The other thing might be exit fees as well. Just check early repayment. But yeah, essentially those power of attorneys and some of those other more sneaky methods, I suppose, of kind of the lender recovering their debt can be a little bit dangerous at times.
Yeah, I understand. Yeah. So let's talk about a particular client of ours.
Yes.
We've been trying to work with him for the last several months, trying to find him a property and a suitable sort of lending solution. And I guess his situation is he's just come out of a full-time working sort of position. He was obviously earning a very healthy salary at the time, but now that he's just exited his full-time work. And we're trying to find him a commercial property to buy. He's got a lot of equity, a lot of capital saved up, so he's cashed up. But it seems like the serviceability piece is still a bit of a challenge. So, for someone like him, who wants to get into the commercial property space, and he needs to be able to secure funding, what are some of the steps, I suppose, what are some of the initial steps he should consider taking? And what sort of assets should he be focusing on?
Yeah, for sure. So in terms of assets, someone in that position would normally have to lean towards something that's high net yield for the pure reason they'll have to take out a lease doc facility. Now, lease doc lending, I wouldn't say that it's more expensive than the full doc alternative. However, the servicing hurdles can sometimes be a little bit strict in the sense of we're only using the net rental income to service the loan. So a great example of that, if we buy a property that's only 3% net yield, it might have great capital growth potential. We might only be able to secure a 20 to 30% LVR. If we buy a property that's more around 6.5, now we're getting close to that 60-65% lending limit. So it's very important with a customer in that situation that we consider what product options, but also if we're going to buy a property, and sometimes, like we know, commercial property is very flexible. There's lots of different kinds. It's not like residential where, you buy a property vacant, cool, we'll throw someone in there. If we're using a lease doc facility, we need to have a lease in place before we can finance that. And in the case where we might get a really good deal on a vacant property, we may have to have a backup option. And in some circumstances, that might be private funding. Because normally you want 2 to 3 ways out of a transaction, or completed transactions, another way to think about it. So if we think about it, the first exit strategy for that one would be we can get a lease secured before we settle. Perfect. We get a lease stock facility with a major, it's probably around the 6 to 7% mark in terms of interest rate. Awesome. Worst case scenario, maybe we can bend the arm, depending on the asset, of a non-bank lender, and we might be able to get them to provide some level of funding based on a draft lease, and we might be able to find a solution there. It's probably going to be a good 200 basis points above the major banks. It's quite a bit more expensive debt, but it's another good solution. And the third way out is private funding. So if we can't get a lease in place, we want to buy the vacant property, we don't have income to service on the personal side, we can get private debt for that property, depending on the LVR, and that ensures the customer settles. And within that 12-month period, we just have to secure a lease. Once it's leased, we can use the lease stock to refinance it. If it's a really good lease, compared to what we originally thought, we might even be able to pull a bit of cash out and put a bit of money back in the pocket of the borrower. So there's 3 exit strategies for someone who might want to buy an asset that mightn't have the income, but has the deposit behind them. Really good for expats and other people who have been overseas and they've come back, saved a lot of money, and want to park that money somewhere, but might be on a bit of a career break. I've had a few customers like that, and we go down the option of lease stock. Same if they've got a trading business, they might have a little bit of debt, maybe a resi portfolio that may not be structured with trusts or something like that. It might be a little bit separate. And in that instance, lease stock's fantastic because we're not looking at the existing liability.
Yeah, interesting. So how does the typical bank calculate serviceability for a lease stock loan?
So lease stock's really good because you can do the calculations essentially on the back of a napkin. It's very easy. The bank normally wants 1.2 to 1.5 times servicing for the loan. And what that essentially means is if you borrow $1 million at a rate of 5%, you've got $50,000 per year of interest. The bank wants to see income to the equivalent of, if it's 1.5, it's 1.5 times that interest.
So 75,000.
Yes, correct. So if you've got 75,000 of income, you can technically service that loan, and therefore the bank will provide you funding. So it's a very easy calculation, as long as the asset's good. The main thing that comes into play with lease stock is the term of the lease.
It's the whale.
If you have a very short whale, say everyone's coming up, no one has options, you're going to be due for a review very quickly on that facility. Whereas if it's a bit longer, we might be able to get a few additional years in there of set and forgetness before we have to jump in and start doing reviews, which can be beneficial, especially if the person's busy. No one wants to be doing really long annual reviews. So if we can push that out, it makes it a lot easier.
So how easy is it? Let's say there's a property that's 1.5 year whale, and we get a loan for 1.5 years. And then during that 1.5 years, we renew the tenant for another 5 years. How easy is it for us to renew that loan?
Yeah, it's extremely easy. We just provide the new lease to the bank when it comes due. If it's a lease stock loan, there's no other information they're going to require to analyse anyway. They may or may not want a new valuation, depending on how long it has been. Sometimes a new valuation is not a bad thing. It does come normally with an upfront cost. However, if you get a really good valuation and you've done a bit of value add and you've signed the tenant on at a better lease, it comes in higher, it may knock us down an LVR bracket, which means cheaper interest rates. So it's not always a bad thing, but essentially it's a very easy process. We supply the new lease, it gets reviewed and extended for the new term.
Yeah, great. So you touched on valuation. I want to talk about that as well, because we've had instances where valuations, in my opinion, were just ridiculous, right? And one of my valuer mates said that valuation in Australia is not a science, more of an art.
Yes, correct.
And a lot of times, if the valuer is having a bad day, sometimes they might take it out on the valuation. So I've seen cases where let's say we're buying a $5 million property. The valuation comes in. The first valuer comes in at $4 million, and we order a new valuation, and the next valuer comes in at $5 million.
Yes,
I mean that's a huge discrepancy.
Yeah.
So I suppose one is, why does that happen from your perspective, and number two, how can we challenge these valuations?
Yeah, for sure.
Or can we?
So we can challenge them.
Uh-huh.
A good example is recently I had a customer, good residential portfolio. We wanted to tap into some equity to buy another property. We did 4 valuations across a couple of banks, and between the highest and the lowest, it was 300,000 to 400,000 worth of equity that we could access. And when buying a property, that's a decent difference.
Yeah.
So you're right, it's definitely an art, it's not a science. In terms of challenging valuations, it's residential, we can show comparable sales. If it's commercial, we need to have a look at what comparables they've used and see whether there's other comparable properties that might be let in for more per square metre, and show them, hey, it's a similar property, it's let in for this much per square metre, you know, it's not above the market, we actually believe the market's here, and you can try and contest it and bring it up. It is difficult, however, and it's very much, I have had valuers give lower valuations than others for no real reason. Similar properties, you know, just 2 different firms. They're inspecting the same property, similar comparables, and yeah, it's a big difference. So sometimes we do have to challenge valuations, and we do have to try and squeeze them. Luckily enough, at the moment, most are coming in at contract price, which is amazing.
Okay.
It's more when we want to get that little bit extra and say, I've got a customer at the moment, we've got a property in a unit trust, it's unencumbered, we want to borrow some money against it to buy another commercial property, leverage into the next one, and the issue will be what valuation we get, because they've got good serviceability, and the deciding factor of how much they can leverage into the next one will purely be what we can get on that valuation, take it back up to 65-70%. So yeah, valuations are always a bit tricky. In that instance, if it's a purchase, we can look at different lenders. So some lenders will allow us to bring your own valuation.
Okay.
Normally in the non-bank private space, we can normally do that. So if you buy a property and let's say it's worth $5 million based on comparables, and the valuer is having a really bad day and values it at 4, we need $5 million for funds to complete and actually be able to borrow the required money. We can get our own valuation done and take it to maybe a private lender who accepts that and get the deal done.
Okay.
It's not the nicest way to do it.
Yeah.
It's very expensive, but it's a solution.
Okay.
Yeah.
So, so in that instance, for example, you've got the valuation, the initial valuation of $4 million. Can you challenge the valuation, and would the bank accept the challenge?
Yes.
Okay. So the bank would then say, all right, well then we'll adjust the valuation to adopt $5 million, and we'll lend in accordance.
Correct.
Yeah.
If the valuer adjusts their original opinion and provide a new report, you can certainly increase it. Some banks are a little bit funny. If they've been provided the original one, sometimes they won't. But what I've found, we've challenged quite a few valuations in the past for equity draws, and the bank can sometimes support and assist with the valuation escalation if they're the one that's ordered the val, because it will have to go through the channel of who ordered it. But yeah, in most instances, if you can get the valuer to change their report, they're more than happy to land on the new amount, because at the end of the day, the valuer signed off on the report. That's their opinion of the market.
Yeah.
If that's where it is, that's where it is.
Yeah. Yeah. Fair enough. So over the last 12 months, what sort of assets have you seen your clients buy the most? Like what are the trends that you've seen?
Definitely industrial.
Okay.
Haven't seen much retail, maybe one. Haven't seen much office space. It's mainly industrial. It's probably one of the bigger one. We're looking at a lot of customers now who want to buy their next commercial property and purchase the first one as a retail shop, because that's what we all know, right? We know retail, we see it, we can touch it, we can feel it. You can walk past it, get a coffee if it's a cafe. A lot of people like that. We are certainly seeing people transition more to the industrial now. For the main reason, there's some longer lease terms, depending on the tenant. If they install some equipment, it might be hard for them to move. If they're a good trading business that's within that property, then it's a really good purchase. So we're seeing a lot of that at the moment, not too much in terms of retail. That's probably one of the main ones. Big move away from office space, obviously post-COVID. Before COVID, you'd get the odd inquiry for office space, but now office space, I haven't seen one for the last year or two.
Yeah, wow.
People purchasing that, not for their own use. It's probably the way to put it, as an investment. For their own use, some people will. Some great ways to structure that with your super fund, but essentially, it's mainly industrial property now.
Yeah, okay. And do you see that continuing for the rest of the year, 2024?
It'll certainly be interesting to see what happens. I think if the economy strengthens, then we might see a little bit pushed back into retail, depending on who's offloading their assets and what's happening there. But we'll just have to wait and see. I think industrial is an asset class that, for the majority of the time, if purchased in the right location, can kind of stand the test of time and is quite resilient in some of the up and down economies. Because if you have a warehouse that that produces a certain product, if we're in COVID, if we're not in COVID, if it's a good year, bad year, depending on the strength of the tenant and what they supply, and I suppose the elasticity of what they supply is, it's could very well be a good investment to stay within the industrial. But at the same time, retail can also be a good investment. It just really depends on the property. But I do think we'll see more retail property start to come back through. It just depends on the strength of the economy.
This is a question that you probably get asked every single day.
Yes.
Okay. What's happening with interest rates?
Oh, yes. It's a very good question. It's, don't have a crystal ball, but essentially the general consensus is that rates will come down.
When?
Hopefully, well, that's the biggest question. When's a great question. I would like to think the end of 2024, start of 25 is still kind of where people are sitting. But at the same time, no one expected that many consecutive rate rises coming out of COVID either.
True.
Some people predicted it, others didn't. It's very hard to kind of find the right answer. I think the main thing is if we're buying the correct property and we're structuring our debt in a relatively low risk way, and what I mean by that is if our servicing's tight now and we're forced to go to a private lender, we should probably think about moving now and getting back into the bank land once we've settled, rather than wait until the end of the private term. We might have already paid interest, capitalised for that 12 months, so we're going to have to pay the same interest anyway. But if for some reason rates go up 0.5% over that 12 months, we may not be able to refinance. We're stuck in a sticky position. So I think as much as it's nice to try and make the decisions with the fixed rates and lock things in, at the moment, I would say 99% of our customers are staying on the variable side of things for that potential drop. We're relatively resilient if there's another rise or two. For some reason, it's not going to put them into hardship or force them to sell the property, just because they've bought good assets with good net yield, which you can help with, which is good. Makes it easier.
100%.
But in terms of them going up or down at the moment, my non-financial advice would be to stay on the variable side of things and see what happens. If rates come back down 2%, then probably consider fixing, but we'll see.
So, staying on the topic of interest rates.
Yes.
So, in your line of business, do you get more transactions when the interest rates go up or when interest rates go down?
Funnily enough, they stay relatively the same. Which is very interesting.
Why is that?
Well, it's a good question. I think it's more interest rates go up, interest rates go down. A lot of people are still living their lives, and rates are what they are depending on what they buy. Like a very good thing is when COVID happened, a lot of people didn't buy property. There's a lot of people that sat on the sidelines and went, no, it's going to crash. We've got this worldwide virus that's going to be horrible. And property boomed, right? But then we come out of COVID and rates started to go up and people thought, oh, it's going to crash, I'm going to hold off. We'll see what happens. And once again, property boomed again. And now we're on another rally. So I think when it comes to interest rates and why people necessarily, the inquiry, it's slightly affected by rates. When rates started going up, it did drop back ever so slightly, but nowhere near what you'd expect it to. Like we had our biggest month this month, and arguably we're at the highest interest rates we've seen for a few years.
That's true.
Yet we've got record lodgements, record inquiry, record commercial property settlements. Everything's up through the roof. And I think it's mainly because people are still living their lives. People know that time in the market's better than timing the market, especially with interest rates where, unless you are in the Reserve Bank, you probably don't know what direction they're going to head. Same with the rate rises. Put people on the sidelines, like I said before, and now they've missed out on a lot of capital growth. So, I think it's very important that regardless of rates are up, rates are down, we stick to fundamentals of the property and structure our debt correctly, and I think we'll be okay and relatively resilient.
Well, Nick, I want to ask you about the mortgage cliff. So we're seeing a lot of it on social media and the newspapers and all that. Number one, what is it?
Yes.
And number two, how could it potentially affect investors and the property market?
Yeah, for sure. So the mortgage cliff's probably the buzzword at the moment. Well, it certainly was 6 months ago. And the reason it, I suppose, come into the media was essentially a lot of banks had a lot of fixed rate loans, and we were one of them. We fixed a lot of customers 2-3 year fixed rates when they were really low, which was great. Rates went up, people's repayments didn't go up. They were living the same way as what they were probably 12, 16 months prior to that, which was great. But essentially, the idea was everyone would roll off their fixed rate, repayments would go through the roof, households would feel the pressure, mortgage arrears would spike, and everyone would want to sell their property. What we saw when that rolled off, and it was late last year, was the main kind of time that everyone was really hanging on for, is they come off. And those people, okay, there might have been a small uptick in hardship. I know of one of our customers that sold more so their situation had changed rather than the rate rises, but it was enough to put pressure to sell. Everyone's resilient and holding on. They continue to make their mortgage repayments. They cut back in other areas. And I suppose one of the major fears was a lot of those home loans were assessed at a 2.5% buffer, which means that if you have a home loan rate of 2%, which is what they were back in the day, it's hard to believe, isn't it? 2% plus a 2.5% buffer, we're at 4.5%. Rates are now at 6%. So what everyone was thinking was, this is going to go up. Once we're above that buffer rate, everyone that scraped through 12 months ago is going to default. And look, APRA responded and increased it to 3% in terms of the buffer rate to try and warrant some of that. And obviously that still wasn't enough because the rates are higher than 5%. But I think a lot of people just held on. I think we've had the rate increases. People have changed their living style. They're valuing their properties a little bit more than selling and having to go back to renting. I think that's probably a big one in terms of the owner-occupiers out there. With investors and investor stock, I'm yet to see any of our investors unload, mainly because there was maybe 12 months of a really horrible time for those that weren't fixed. The rates kept going up, kept going negative cash flow. But one of my investors, for example, they've got a small unit they bought in southwest Sydney. It's been able to put up the rent $250 per week because the rental market is now starting to catch up to where it should be before. And our negative cash flow is starting to flip around and we're almost cash flow positive again, which is great. But with the mortgage cliff, I don't believe it's going to be an issue. We haven't seen a lot of unloading of stock. We've only seen property prices go up. And now with people flooding into the market like they are now, the only ones to worry about are people who might have had personal situation changes. I feel like a lot of those people would probably rent their property out before they sell it, make a loss and have to start from scratch.
Okay, interesting. In terms of foreign buyers for investment, so we just had Josh Charles here for the podcast, and he said there's a lot of foreign investment coming in. A lot of them are using local platforms, but the money's coming in from overseas, Singapore, the US, just to name a couple of places. Have you seen or have you been in, I suppose, direct contact with the overseas investors, and how are they behaving particularly, and how do they view, I suppose, the lending landscape here in Australia?
Yeah, for sure. It's certainly starting to pick up. We have a lot of people now who are starting to want to enter the market and bring their money over, which is fantastic in my opinion. We've had a few relatively large purchases recently from overseas investors, which is good. I think it's just they want to diversify their asset base and what they're holding. And I think that Australia is a great country with some really good buys, even with the interest rates we have at the moment. There's still great commercial properties that still cash flow at the interest rates of today. Right? And if we think about it for those particular investors, depending on where they're moving their money from as well, the Australian dollar was a little bit weak there for a while, and their buying power here versus potentially where they're based was a lot higher. So a lot of that capital started to flow in. But I certainly think that there's an uptick I think, in the last maybe 2 to 3 months, inquiries for people based overseas. And they're from everywhere. Like, I've got people in Bali, people in Singapore. I chatted to people this morning who were based in Italy, another one in Germany. There's people everywhere where the money's coming from. It's just people who are looking to diversify what they hold.
Okay. And do you see that trend increasing throughout this year? Or?
I think so.
Okay.
I think now we've come over Christmas and our interest rates are starting to stabilise. I do think we might see a little bit more inquiry. I don't think there'll be a driver to really push it and really put it through the roof. I think at the moment banks are looking for trading businesses that are operating really well in Australia, and they're giving them higher LVR limits and potentially slightly reduced serviceability, and they're really trying to grow their books with those strong performing businesses. Is where I'm seeing it open up. In terms of the foreign investment and that opening up, I think there might be a small increase and small improvement, might be a better word for it, in bank policy. But at the moment, I think it will increase, just incrementally.
Okay, but not too impactful.
No.
Yeah, fair enough. I've just got a couple of questions.
Yeah, for sure.
So, how would you describe your ideal client?
Yes. So for us, our ideal customer, now we are a brokerage that serves everyone in different ways. So I personally focus on commercial property and investment portfolios of resi properties as well. We have other brokers in our business that focus more on the first home buyer and the purchasers. So we can service everybody. Our ideal customer generally wants to get into commercial property. Doesn't matter if they know what they're doing, we're happy to educate them and take them on that journey. Or is looking for their 10th commercial property and needs financing for that and assistance structure in their portfolio. So we're happy to work across all of that. Like I said, the ideal customer, doesn't matter if you're brand new to commercial, we have resources we can guide you through, but we also have internally software that we've developed to make it very easy to very quickly assess borrowing power for commercial, purchase power, even in complex portfolios. We can have 10 residential properties, maybe a couple of resi properties, a couple of commercial. We can work with all of that extremely quickly. A lot of the industry is still in Excel and other places, which is fine, but some of the tools we have, I've built to make things happen very quickly. So anyone that's looking at commercial property, essentially, the only other thing that we can look at is people who have resi investments, want to get into resi, because we can help them structure that correctly. That can help them get into the commercial market later. So we have a lot of people who have an owner-occupied property, maybe 50 to 60% LVR. And they're like, look, we're looking to diversify. We want to buy a commercial property or property in an SMSF as well. Commercial property in SMSF is a great option to look at too, self-managed super fund. And we can help them take that step. We can show them how to take the money out, how to structure the debt correctly, and then kind of walk them through that entire process to ensure that we have the correct entities set up with the accountant and the funding set up in a way that's doesn't require a lot of maintenance, which I think is important. So private investors looking to get into commercial or buy or grow the commercial portfolio. Exactly right.
Excellent. Well, Nick, where can people find you?
So it's not too hard to find us. If you search the Lending Lab in Google, you'll very easily find our website. We are on all major social media platforms as well. Some of our content, all of our educational content's free and available anywhere in the world. So you can very easily get it. But the easiest way to contact us is either through the website, or you can contact me directly, or through any of our social media channels. I'm primarily on LinkedIn. So if you add me on LinkedIn, I talk quite often about commercial property, different structuring, the lease stock scenario, different things that we come across for people interested. And it's probably the easiest place to find us, either on LinkedIn, social media, or through the website.
Excellent. Well, we'll put a link to that down below in the comments. Well, Nick, thank you so much for your time today. It was a pleasure having you here.
Thanks, Will. It was great.
You taught me a lot.
That's always a good thing.
So I feel like I'm better equipped now to communicate these things to my clients.
Fantastic. Thank you.
Thank you so much. And love to have you on again.
Thank you. You'll have to come on my podcast now.
That sounds good. Let's do that.
Awesome.
Thanks, Nick.
Thanks, Will.